In this video, I'm going to explain exactly what are the differences between a mutual fund, index funds, and ETFs or exchange traded funds. As a personal finance YouTuber, I get this question asked a lot because these three things are quite similar, but there are very important differences that you should definitely know about. If that's something you're interested in, definitely watch this entire video. Hey, what's up guys? You're watching Boss Your Money with Anthony. Don't forget to subscribe down below, turn the notification bell on so you don't miss a single video, and also don't forget to turn the like button blue. All I do on this channel are personal finance tips and tricks where I help you get rid of your debts, increase your wealth, and just help you manage your finances better. So if you've done all of that, let's get straight into the video. Let's start with mutual funds. Mutual funds are something I'm sure most of you have heard of. It's the most popular kind of investing. So what exactly are mutual funds? Mutual funds were created as a concept way back in the day where people could pool all of their money together and buy some investment. This meant that they could actually afford to invest, but at the same time, when their investments did well, they would all share in the profits. Today, mutual fund is an instrument of investing where you could go and buy one mutual fund that has a collection of various different asset classes in its portfolio. There are lots of different types of mutual funds. You have mutual funds on emerging market stocks, you have bond mutual funds, you have a balanced mutual fund where they have real estate, stocks, bonds, all of them together, where you get to maximize your returns but also keep your risks low. Mutual funds give you diversity because you get to buy one mutual fund where you have various different classes of assets included in it. And the best part about this is that they are managed professionally by fund managers. So people who know what they're doing and who know how to buy and sell stocks, how to read the stock market, they are the ones who are actually buying and building a portfolio in which you get to invest. Because it is managed by people who know what they're doing, they generally tend to do well, and because they tend to do well, you don't have to do the hard work of researching and understanding the little boring things about finance. They're also very easy to buy. You don't have to buy 10, 20, 30 different stocks individually, because not only would you have to pay the transaction fees for each different stock item, but it's also going to be very time consuming to actually track and understand and learn and research about each and every stock item. Rather, it's easier to research a fund manager who you trust in and also find a fund that is suitable to your goals and your aspirations. The downside to all of this is that because they are professionally managed, these professional managers have to be paid their salaries. When I say professionally managed, I'm talking about someone actually physically sitting in front of a computer, doing their research and investing in every single aspect of the portfolio that they've put together, be it buying or selling. And that's a lot of hard work. And they usually paid the big bucks. So when that happens, that comes out of your investment fees. So they tend to typically have a higher fund management fee. Then there is the index fund. Simply put, all index funds are actually mutual funds, but not all mutual funds are index funds. As I said, there are a lot of different types of mutual funds that you can invest in, and index funds are kind of like a mutual fund. So what is an index, first of all? An index is a collection of stocks, and an index is valued at the average movement in price of the collection of stocks that are part of that index in any given period of time. So essentially, you can use an index to quickly measure the performance of the entire stock market at that point in time. As an example, one of the most popular index out there is the S&P 500 in the US. And the S&P 500 index includes stocks like Apple, Google or Alphabet, Amazon, you name it. It's a collection of 500 different stocks in the US stock market. For example, let's say you want to invest in a single stock. And just for this example, I'm going to take Apple. You want to buy Apple. Do you know how to read the balance sheet and the profit and loss and the entire financial statements of Apple stock? If you don't, then that's a bit of a gamble, because you need to understand the figures, you need to understand the management of a company, because investing in a stock means you're part owner of that stock. Even if you do know all of this, let's say you buy the stock. Once you buy a stock, the price of the share might go up or down. And if your stock price decreases, you're losing out on your investment. But on the other hand, if you're investing in an index fund, the collective stock market as a whole or the collection of shares in that index would as a whole have to go down in value for you to actually be losing money. So investing in index funds are definitely a safer option, especially for newer investors. And in this example, the S&P 500 has 500 huge companies that would all have to perform badly for you to actually lose out on your investment. So now that you understand what exactly an index is, index fund is you investing in that index as a whole. So since the index fund is market driven and not actively managed by a professional fund manager, your charges and fees for the fund are typically way lower than buying into mutual funds. So S&P 500 is not the only index in the world. There are lots of different indices all over the world for you to choose from. So take your pick. So now you know what a mutual fund is, you know what an index fund is. What is an ETF? ETF is an index fund, but there is a small difference. An ETF is an actively exchange traded fund. What does that mean? That means that index funds have one value per day. That means today the value of an index fund is today's value. The value of that index fund is not going to change in the next second or in the next minute. It's going to change only on the next day when the stock exchange is open for trading. But ETF, on the other hand, is an index fund, but it does change every single second in value, just like any other stock would. So if you open any stock chart, you would be able to see the ups and downs every single second based on live active trading that happens every day. And ETFs are exactly the same. You can trade them as a stock principally that can go up and down every single second. So essentially what that means is that it really doesn't matter whether you choose to start investing in an index fund or an ETF, as long as you're determined not to keep looking at the charts every second and make any kind of impulse buying or selling decisions. Your investments should always be aimed at long-term investing, because if you're trading in the short term, that is definitely a little bit like gambling. No one really knows what's going to happen in the next few seconds. So as long as you're strong about that, you're free to choose between index funds or ETFs. And by the way, if you're interested in investing in the US stock market in index funds from the UAE, if you are in the UAE, then I have made a video on a platform that allows you to do just that. The platform I'm talking about is called Sarva. I have made a video on how that platform works. I'll leave the link in the description below. Or if you're already familiar with Sarva, you can go ahead and sign up for it straight away, and I'll leave that link in the description below as well. And don't forget to start investing as soon as possible, because the sooner you start investing, the more money you're going to make. The best part about this platform is that they do allow you to have long-term investment plans, and they also allow you a systematic investment option where you can transfer funds every single month in a systematic manner. They also allow you to reinvest your dividends free of charge. Also remember, the stock markets are always going to go up and down. They are volatile. However, if you see the charts over the last few decades, you're definitely going to see an upward trend. So don't wait for the markets to drop to start investing. Start right now, start today. If you have any questions, please let me know in the comment section down below. If you haven't understood something that I've just mentioned, also let me know in the comment section below, and I will definitely try to explain it in detail. If you found any value from this video, don't forget to turn the like button blue. Subscribe to my channel for more awesome life-changing financial advice videos. I'll see you guys in the next one. Take care.